Something big just happened in the world of Pi Network. If you've been following the project, you know that major changes don't come often, but when they do, they send shockwaves through the entire community. This time, it's not just a technical update or a new feature, it's a move that has everyone talking, speculating, and even worrying about what comes next. Imagine a giant vault of treasure. Suddenly, 200 million pieces are moved to a new location. That's the scale we're talking about here. It's as if a hidden fortune, carefully guarded for years, was suddenly picked up and shifted somewhere else overnight. For a project as closely watched as Pi Network, this is a seismic event. That's what just happened with Pi Network's tokens. 200 million tokens, representing a massive chunk of the ecosystem, were transferred in a single, highly visible transaction. The blockchain doesn't lie, every move is recorded, and this one was impossible to miss. In crypto, every move is public, and this one set the Pi community buzzing. Social media channels, forums, and chat groups lit up with theories and questions. Was this a planned move by the core team? Or was it something more mysterious, maybe even a sign of things to come? Who moved the tokens? Where did they go? What does it mean for the future of a project millions have mined on their phones for years? For many, this was the first time they realized just how much is at stake, and how quickly things can change in the world of digital currency. Pi Network is still in an enclosed mainnet phase, so tokens can't be traded freely. This means that, for now, most users can only watch from the sidelines as these massive transfers take place, unable to buy, sell, or move their own tokens outside the network. Any large movement from reserves is a major event. It raises questions about the project's direction, the intentions of those in control, and the future value of the tokens themselves. Some see this as a sign of big investors getting involved, others worry about transparency and delays. The lack of clear communication from the team only adds to the uncertainty, fueling both hope and anxiety among Pi's global user base. This single transaction has captured all the hopes and fears around Pi Network. For some, it's proof that the project is moving forward and attracting serious attention. For others, it's a warning sign that not everything is as it seems. It's a pivotal moment that forces us to look closer at the project's mechanics and community sentiment. The way the team handles this situation could define Pi's reputation for years to come. In this video, we'll break down what happened, explore theories about the transfer, especially the over-the-counter deal, and look at Pi's price action. We'll analyze the facts, separate rumors from reality, and try to understand what this means for everyone involved. We'll also dive into user frustrations and the high expectations for the upcoming Pi Day 2 event. With so much anticipation building, the pressure is on for the team to deliver answers and progress. By the end, you'll have a clearer picture of this complex situation and what it could mean for Pi's future. Let's get started and unravel the story behind the move that has everyone talking. To understand the impact of moving 200 million tokens, we first need to grasp the concept of liquidity reserves and why they're so crucial in the world of cryptocurrency. When a new token is about to launch or be listed on an exchange, one of the most important factors for its success is liquidity. The ability to buy or sell the token quickly without causing dramatic price changes. That's where liquidity reserves come in. These are pools of tokens set aside specifically to make sure there's enough supply for trading so buyers and sellers can transact smoothly and the market remains stable. Think of a liquidity reserve as a safety net for the market. It's like a pool of tokens that acts as a buffer, absorbing shocks and preventing wild price swings when trading activity spikes or drops unexpectedly. It's the grease that keeps the wheels of trading turning. Without it, prices can swing wildly, and confidence in the token can quickly erode. For any new or growing cryptocurrency, maintaining a healthy liquidity reserve is essential for building trust and attracting new investors. Removing 200 million tokens from this reserve is like a massive withdrawal from a central bank's vault. It's a move that can send ripples through the entire ecosystem, raising questions and concerns among traders and investors alike. The big question, why? In this case, the tokens weren't sold on a public exchange but instead were moved to a private wallet. This means they're no longer part of the official liquidity pool that supports active trading. This reduces the official reserve, which could affect future liquidity. With fewer tokens available for trading, the market could become more volatile, and large trades might have a bigger impact on price. On the other hand, If these tokens went to a long-term holder or strategic partner, it could be a positive sign, less selling pressure when Pi goes public, and perhaps a vote of confidence in the project's future. But it also means less liquidity for future listings, which could be a concern if demand spikes or if new exchanges want to list Pi. The balance between available supply and market demand becomes even more delicate. The real story is in the why behind the move. And that's what has the Pi community speculating. Is this a sign of a major partnership, a strategic investment, or simply a shift in how the project manages its reserves? Was it a strategic sale, a partnership, or something else entirely? Each possibility carries its own set of implications for Pi's future. The implications are huge for Pi's future market dynamics, and the answers could shape how investors and the broader crypto community view the project going forward. The leading theory behind this massive transaction is that it was an over-the-counter, or OTC deal, a private sale conducted directly between two parties, away from the prying eyes of public exchanges. OTC deals are common in traditional finance, but in the world of crypto, they take on a special significance due to the volatility and transparency of blockchain networks. In the crypto space, whales, those holding enormous amounts of digital assets, often rely on OTC desks to buy or sell huge sums without causing wild price swings. These desks act as intermediaries, matching buyers and sellers discreetly, and ensuring that the market remains stable. If a whale tried to buy 200 million Pi on a public exchange, the sudden demand would send the price skyrocketing, triggering panic buying and potentially crashing the system. The order books simply couldn't handle that kind of volume without massive slippage. OTC deals allow these big players to negotiate a fixed price quietly, behind closed doors, avoiding the chaos and attention that comes with public trades. This privacy is crucial for both sides, especially when the stakes are this high. The only public evidence left behind is the token transfer between wallets, exactly what we observed on the blockchain. There's no public order book, no price spike, just a massive movement of tokens from one address to another. Many analysts interpret this as a bullish signal. After all, why would a major investor acquire such a huge amount of Pi unless they had strong conviction in its future potential? It suggests a level of confidence that goes beyond mere speculation. Moves like this often signal growing institutional interest, especially with the Open Mainnet and potential exchange listings just around the corner. It hints that big players are positioning themselves ahead of major developments, but it's important to remember that this is still just a theory. The PiCore team hasn't confirmed any details about the transaction, and there's been no official statement to clarify what really happened. This lack of official communication has left many investors frustrated and anxious, fueling endless speculation and debate within the community. Some worry about transparency, while others see opportunity. Was this a strategic internal move, a new partnership in the works, or simply a massive sale to a single investor? The possibilities are wide open, and each theory sparks new questions. For now, the OTC theory stands as the most logical, and for many the most hopeful explanation for this mysterious transaction. It offers a narrative of growth and confidence, even if the details remain hidden. The entire Pi community is watching closely, waiting for answers, and hoping that this is just the beginning of something much bigger. Pi's price has been volatile, and this news adds more drama. As of mid-June 2025, Pi trades around 64 cents, up slightly today, but down 40% over the past month. This drop has shaken confidence, especially since Pi's price is based on IOUs, not real tradable coins. These IOUs are speculative placeholders, so the price doesn't reflect true market value yet. Still, the drop reflects growing impatience and doubt among holders. Delays and lack of updates have led some to sell, pushing the price lower. But the 200 million token transfer, if it's a bullish OTC deal, could mark a turning point. Large investors may see this as a buying opportunity at low prices. Analysts are watching the $1.20 resistance level. If Pi breaks through, it could trigger a rally. The next few weeks will show if this event can reverse Pi's fortunes. For now, holders are watching and waiting. Despite the price slump, many in the Pi community are optimistic. They believe the token transfer was a massive OTC purchase by smart money, big investors betting on Pi's future. These investors are accumulating before the Open Mainnet and possible listings on major exchanges like Binance. If demand surges after launch, early buyers could see big gains. For pioneers, this is validation of their faith in the project. The $1.20 resistance is the key level to watch. Breaking it could spark a rally toward $2. Beyond price, Pi's huge user base is a major asset. If the core team delivers on Open Mainnet and ecosystem growth, Pi could become a true crypto powerhouse. Optimists see the recent move as the first sign the project is waking up. Not everyone is convinced. Skepticism runs deep in the Pi community. Critics point to years of delays and a lack of Open Mainnet, leaving millions with untradeable tokens. The core team's silence on major moves only fuels suspicion. Some worry the team is selling tokens for their own benefit or struggling internally. A 40% price drop in a month shows many are losing faith. Bears argue that hype is fading, and a big user base means little without real utility. Some even question if the project is monetizing user data rather than building value. The recent token move without explanation adds to the doubts. Until Open Mainnet launches and Pi proves its worth, skepticism will remain. For now, trust is wearing thin. Beyond price and speculation, many pioneers face a practical problem: KYC issues. KYC is required to claim mined Pi, but many users report delays even after approval. Years of daily mining, yet tokens remain stuck in limbo, frustrating the most loyal users. Social media is filled with complaints. Where are my tokens? These delays damage trust and credibility, especially with no clear timeline or explanation. A smooth KYC and token distribution process is essential for any crypto project. The core team must urgently address these issues to restore confidence. Without trust, even the most exciting announcements lose their impact. All eyes are on June 28th, Pi Day 2, the community's most anticipated event. This year, expectations are sky high. Will the core team finally announce the Open Mainnet launch? That's the holy grail for pioneers, unlocking real value and tradability. A Binance listing is another major hope, bringing exposure and liquidity. The community also wants answers about the token transfer, KYC fixes, and a clear roadmap. Pi Day 2 is a chance for the core team to restore faith, or risk losing it for good. Substantive announcements could ignite a new wave of enthusiasm. Vague promises could do lasting damage. The pressure is on. The 200 million token move has brought Pi's hopes and doubts to the surface. Bulls see it as a sign of big investors betting on Pi's future. Bears see more delays and broken promises. The project's success now hinges on real progress: Open Mainnet, KYC fixes, and clear communication. For pioneers, the best approach is to stay informed and watch for concrete action, especially on Pi Day 2. The next chapter will be written by what the core team does, not what it says. Trust, execution, and transparency will decide Pi's fate. Will this be the start of a breakout or just another confusing twist? The world is watching and waiting.